If you have searched for private equity journal entries, you have probably seen the cheat sheets. 20 entries, clean boxes, looks complete. But many of them make a mistake in the very first entry. And in a fund accounting interview, that mistake can immediately expose whether you understand the workflow or have only memorized debits and credits. When an investor commits capital to a fund, no cash has moved, nothing has reached the bank. So, booking cash on the commitment date is usually wrong. In this video, I'll walk you through the core journal entries across a simplified private equity fund lifecycle, the way a fund accounting desk thinks about them. And I'll flag 3 areas where one size fits all cheat sheets become dangerous. One of them is the carried interest question that can divide even experienced fund accountants. For this video, we'll organize the core entries into 5 phases: fundraising, investment, monitoring, exit, and wind up. Let's go phase by phase and identify the interview traps as we reach them. Phase 1: Fundraising. Day 1. An investor signs the subscription documents and commits $50 million. What do you book? Here is trap number 1. Usually, nothing in the general ledger. A commitment is a contractual promise to provide capital when called. It is not cash, and it is not yet a receivable simply because the investor signed the documents. The commitment is generally tracked through the investor records and the unfunded commitment schedule. No debit to bank, no credit to income, just accurate commitment tracking. The accounting changes when the fund issues a capital call and the amount becomes due under the fund documents. Many funds then record debit, capital contributions receivable, credit, partners capital or contributed capital depending on the fund's chart of accounts. The investor now owes the called amount to the fund. When the cash arrives, debit, bank, credit, capital contributions receivable. The receivable clears. Now the cash is real. The exact recognition point can depend on the fund documents and accounting policy. But the core interview principle is simple. Commitment signed does not mean cash received. So if an interviewer asks for the entry when a commitment is signed and you immediately debit bank, that tells them you may have memorized an entry without understanding the event behind it. Phase 2: Investment. These are the entries that fill a fund accountant's working day. The fund invests in a portfolio company. Debit, investment in portfolio company. Credit, bank. A follow-on investment generally uses the same basic entry. Debit the investment, credit the bank. The commercial reason may be different, but the core accounting movement is the same. Cash becomes an investment asset. Now consider deal costs. This is not simply a choice between capitalizing everything and expensing everything. Costs that are direct and essential to completing an investment may form part of the investment's transaction price, depending on the applicable accounting framework. But broken deal costs, general fund costs, and expenses that would have been incurred regardless of whether the investment completed are generally expensed. The deciding factors are the nature of the cost, the accounting framework, and the fund's documented policy. Then there is the management fee. When the fee is accrued: debit, management fee expense; credit, management fee payable. When it is paid: debit, management fee payable; credit, bank. The entry itself is straightforward. The more difficult question is the fee basis. Is it calculated on committed capital, invested capital, net invested capital, and when does the step down begin? That calculation follows the LPA, and I have covered the fee basis question separately. Phase 3: Monitoring. This is where the investment remains on the books, but its value and income continue to change. Suppose fair value increases. Debit, investment in portfolio company. Credit, unrealized gain. If fair value decreases: debit, unrealized loss. Credit, investment in portfolio company. These valuation movements affect NAV even though no cash has moved. That distinction matters. Cash movement and NAV movement are not the same thing. Now suppose the portfolio company pays a dividend. Debit, bank, credit, dividend income. If it pays interest, debit, bank, credit, interest income. Those entries are relatively straightforward. But now we reach carried interest. And this is where one size fits all cheat sheets become dangerous. Many cheat sheets show carried interest as debit, carried interest expense, credit, carried interest payable. That sounds reasonable, and in some legal structures, an expense and payable presentation may be appropriate. But in a typical private equity limited partnership, carried interest is generally not treated as an operating expense of the fund. It is usually a reallocation of profits within the partner's capital accounts. Value moves from the limited partner's allocation to the general partner's carried interest allocation. The LP capital decreases, the GP capital increases, but the allocation itself does not reduce the total NAV of the fund. It changes how that NAV is divided between the partners. That is trap number 2. The correct accounting depends on the legal structure, the accounting framework, and most importantly, the LPA. Treat a profit allocation as a fund expense in the wrong structure and you can misstate total fund NAV, the LP and GP capital accounts, and the amount available through the waterfall. Phase 4. Exit. Suppose the fund originally invested $100 in a portfolio company. At the previous reporting date, that investment had been marked up to $140. So the books already contain $40 of unrealized appreciation. The fund then sells the investment for $150. Economically, the total realized gain from original cost is $50. But $40 of that gain had already appeared in prior periods as unrealized appreciation. At exit, the investment balance is removed, the previous unrealized appreciation is reversed, and the full gain from original cost is reported as realized. The exact ledger labels may vary, but the logic must remain consistent. Remove the investment, reverse the unrealized amount already recognized, record the sale proceeds, and recognize the realized gain or loss against original cost. Miss the reversal and you risk counting part of the same gain twice. That is an interview detail worth remembering. A partial exit follows the same principle but only for the portions sold. A full exit clears the entire investment balance. Now the money starts flowing back to investors. And here is trap number 3. Some simplified cheat sheets push commitments, capital calls, contributions, and distributions through one vague account called investor capital commitment. A real fund keeps those concepts separate. When cash is distributed, a common book entry is debit capital distributions or the applicable partner distribution account, credit bank. But that is only the accounting layer. The distribution notice and investor reporting must also explain what the cash represents under the LPA. Is it a return of invested capital, a distribution of realized gain, income, recallable capital, return of excess capital, or another category defined by the fund documents? Those classifications are not cosmetic. They can affect unreturned capital, unfunded commitment, the waterfall, carried interest, and the investor capital accounts and statements. The cash balance may reconcile perfectly while the investor reporting remains wrong, quietly wrong, until an auditor or an LP finds it. And what about DPI? DPI compares cumulative distributions with paid in capital, but recallable distributions, reinvested amounts, and the fund's reporting convention require careful treatment. So do not assume that every dollar distributed affects the performance metrics in exactly the same way. Phase 5. Wind up. The final investment is realized, outstanding receivables are collected, remaining liabilities, expenses, and reserves are settled. Final income, loss, and carried interest allocations are posted to the partner's capital accounts. Then the residual cash is distributed. When the last dollar leaves, the remaining partner capital accounts reach zero and the fund's NAV reaches zero. That is the complete life cycle of a private equity fund, told through its core journal entries. So the next time you see a 20 entry cheat sheet, check the first entry. If it shows cash moving merely because an investor signed a commitment, close the tab. The debits and credits are rarely the hardest part. The real skill is knowing the recognition point, the correct account, the governing document, and what breaks downstream when you get it wrong. That is fund accounting. For more real desk fund accounting explainers, search the Fund Desk on YouTube.